Treasury Secretary Scott Bessent just confirmed that the precious metals rally, in gold particular, is one of the biggest bubbles in the history and soon it will burst. The particular manipulation in the prices of precious metals, according to him, is coming from Asia. Only people in Asia are pumping these particular securities and they're looking for capitalizing on that, simply because like I mentioned, they have problem with the currency, they have problem with international relations, they have problems with conversions, trade agreements, and also geopolitical weakness. Remember, BRICS earlier last month released their first BRICS currency called unit, so obviously there is a big struggle over there. He also mentioned that short-term bubble is coming, and a lot of the people here in the States or around the world except Asia are buying into this rally will get rinsed. Pay very close attention. And remember, this is a guy who worked for George Soros for his Quantum Fund. He was the guy who was sent to work in the London office to cover the European markets, and he was pretty aware and took a very important role in the Black Monday when George Soros made $2 billion betting against the British pound. So the guy is from the markets. He's not some government employee without any market experience. He knows exactly what is coming. So let's run the numbers. Let's see the cautionary tale, why he thinks that the precious metals will crash like never before, and why he sees that a lot of people from Asia in particular are pumping this to put you in trouble and to get your money easily. Here is the concise breakdown of his point of view. First of all, core concern. According to Treasury Secretary, he thinks and he argues that the gold and other precious metals could be at risk of near-term correction or bubble-like. Why is that? All of the people in Asia who are essentially pushing up this rally are using leverage. They didn't use their own funds to purchase this spot market, right? So what this even means is that when you borrow money, when you build a leverage, heavily concentrated position, small changes in the prices directly, automatically liquidate your position. So the greater the margin, the greater the leverage, the more money you borrowing to buy or trade, the smaller amount changes against you, you're getting liquidated. 0.5, 0.3, 0.6% against your original thesis, you're gonna get liquidated. Here's what he also thinks. A lot of these leverage positions are coming from traders around China and China-related trading dynamics. He also mentioned that the liquidity is very thin and stress conditions will force a lot of people to unwind these positions. What he even trying to explain. Last year was very strong for Chinese IPO companies here in the States. I personally have traded many of them that launch on New York Stock Exchange, and when you go prior IPO, you will see the information in which bank is actually helping this IPO. And sometimes you will see the same exact Chinese bank is helping new companies to IPO, to become an initial public offering here in the States. And the speculators knew that every company, for example, that comes with this bank, always there is a sharp rally, day 1, day 2, and day 3, everything dies out. This is why there is a major manipulation, major speculation around these particular IPOs. And this is why he is pretty aware, Scott Bessent, that these are the same traders who are going after IPOs, who are going after quick pumps and dumps. This is why he said that smart investors should be extremely, extremely careful. This is not your rally. This is obviously a rally of China traders and Asia trade in general, especially after the fallout of the Japanese yen carry trade. The second main concerns and how things are actually matching is that the volatile trading from major non-US participants, especially China, are creating this fundamental concentrated risk to the downside that will most likely create a speculative bubble and potentially macro backdrop. Also, don't forget that these people are trading ahead of you, the Far East. So while we're here in the States or in Canada or in South America or even in Europe, these people might actually dump overnight while you're sleeping, right? They pump the rally they're the one who will be dumping the rally. I showed you, watch the previous videos. I made a complete one-to-one head-to-head comparison with the previous run-up in 2022 of the gold. Things look pretty scary simple. Okay, look at this. The bubble risk, according to Scott Bessent, is something that you should be very cautious about. This is different in crypto. Why is different in crypto? Well, crypto, most of the trading is happening in the US. Same thing with S&P 500, the stock market, securities usually. The European stock markets are so slow. Same goes for Japanese, same goes for Chinese, right? The only higher volatility and liquidity is here in the States. So this is why he's warning you. There is a thin liquidity. Very little amount of people are actually trading outside China. What this means that it might be easier to buy, might be hard to sell if you're not living in China or in the area around China. What this is telling you again brings you back to the previous point where if these people start selling India, China, Singapore, Malaysia, if these people start selling, you're here in the States or in Europe, midnight or very early morning, you don't really have chance to do anything about, unless you have limit orders in place. Look at the bubble risk argument. This is also something very interesting. So according to Treasury Secretary, this is a persist above trend moves that is particularly related to the gold. He said that this reflects the combination of speculation around the FOMO trade, right? And without involving other countries to trade, China-related traders will not be able to push it that high. But they were able to create the FOMO effect. They were able to kind of speculate and hype up everyone else, in different countries. So they will participate. This is what actually created the higher volumes and the higher liquidity. But this is no longer the case because we already saw that with the new incoming chair of the Federal Reserve, smart institutional investors, they back off precious metals. They're no longer heavy silver and gold because they know that the closer we get to the new Fed chair, the deeper the sell-offs will be and the smaller and weaker the bounce backs will be. This is why you don't want to be left holding silver average price $100 or above $100. You don't want to be left holding gold at 5,100, 5,100, something we saw. It struggled big time to break 5,100, and this week it might be even crazier, right? So take it from the Treasury Secretary. Don't take it from me. I already given you my opinion, but Treasury Secretary, remember, he meets a lot of international political figures. He met international traders, economists, so he knows exactly what is happening in the background, right? And also, not to mention, a lot of these teams, right, behind the US economy, they do have access to superior data. So if he knows that this is a bubble, he could have said, remember, US also holds gold. If he believed that the gold will go higher and it's in good interest and fate for the US, the gold to go higher, he will say, the gold is very good, it's printing, we know we're gonna double down. Not really. He said the opposite. The gold is in bubble and the bubble will burst, and everyone who isn't in China or China-related territory trade is most likely going to lose. So pay very close attention to this as well.